Hey everyone, welcome to a new series of videos that I'll be doing covering and commenting on various articles talking about tax that pop up in my newsfeed. In these videos, I hope to bring some interesting tax news to attention, find out what we can learn about taxes and their effects on us from them, and maybe I'll throw in some of the lukewarmest takes I can cook up at this point in my learning. Anyways, let's get into it with our first story, which can show both the political aspect of taxation as well as a slight tinge of behavioral incentives. So here it is from January 3rd. I know it's a little delayed. I'm kind of backlogged with these videos, but I can assure you the next video will be much more up to date. GM offers $7,500 incentive for electric vehicles losing US tax credit. Now, I was going to make a standalone video on this, but I had some extremely hot takes that I blurted out and it felt kind of rushed. And I care about you and having to deal with hot takes. First of all, let's go over what a tax credit is. So, when figuring your tax liability, you first take your gross income earned and apply deductions to the amount. After that, the result is our taxable income. This is what would be subject to like a 20% rate to get your tax liability, which we can then reduce with tax credits, effectively lowering or negating the amount of tax you owe. Sometimes they're refundable, so that if your tax liability actually goes below zero, it contributes to a sort of refund that you can either cash out or carry over depending on the jurisdiction. The tax credit here is a refundable credit on the purchase of an EV, effectively lowering the price of a vehicle. GM said it is offering incentives of $7,500 on its electric vehicles that lost a government tax credit. This is from the Treasury guidelines in December detailing new sourcing requirements aimed at weaning the US EV supply away from China. So I went and found the actual guidelines, and from it, they introduced the credit in the introductory paragraph. The credit is $3,250 for certain mineral requirements in the battery, and another $3,250 for the battery and its components, coming together to the $7,500 that they lose if both of those things are from or are manufactured in China. Lower in the guidelines, the reason for this revocation is because they went about classifying China as a foreign entity of concern, as well as any companies whose shareholders include a substantial stake held by the governments of these foreign entities of concern. Building off of that classification, any companies that are involved in the creation of that battery used in the cars, the battery that is needed to qualify for the credit, that are foreign entities of concern, are essentially flagged for their batteries and contributions to the final EV and are essentially unusable for tax purposes. Now, I mentioned that this was a political, maybe more of an international politics or relations angle. Looking at the list of foreign entities of concern, we find China, Russia, Iran, and North Korea. It wouldn't be too hot of a take to recognize that this guideline change is not based on environmental concerns. Rather, it stems from the wider tenuous relationship between the US and China and these other countries on this list. Now, I'm not necessarily a political analyst, so I'll stop right there. But what I can talk about is taxes. And here we can see that politics and international relations are influencing an environmental tax incentive designed to help people switch and consume more electric vehicles in the global push towards net zero carbon emissions. And reading the article, we can see that this is a massive move because the number of qualifying EVs fell from 43 to 19. So that's 24 models that can't benefit, which translates to lower sales because as these vehicles get more expensive than a cheap gasoline vehicle that has established reliability, the vast majority of consumers looking to spend efficiently would opt for more bang for their buck. That's why GM is offering the incentives, because it's such a good behavioral incentive towards purchasing an electric vehicle. In the end, the companies looking to maintain a substantial amount of competition and share in the American market will be making the switch, and eventually the tax credit situation will return to normal. So our next story will touch more on that behavioral aspect I mentioned about the EV being cheaper. Now, this stuff really gets me going. Look at that. Cities with soda taxes saw sales of sugary drinks fall as prices rose. And extrapolating that headline to the electric vehicles we just talked about, we would see the sale of electrical vehicles fall as prices for them rose. I know you're probably saying, but of course, why would people want to pay more for something in general? And then you'll point to how demand in economics function and price elasticity. You're completely correct. We have icing on that cake though. This was affected specifically through a tax, not just mere inflation or business decisions leading to price rises. The author wrote here about the study we'll take a look at in a second, which was conducted using a tax of 1 to 2 cents per ounce of soda, resulting in 67 cents to $1.30 extra in taxes for a 2-liter bottle of soda. In the end, they found that a 33% increase correlated to a demand drop of 33%. a one-to-one correlation in price and demand. Before we go further, let's take a look at economic distortion and price elasticity. The Tax Foundation effectively sheds light on economic distortion here, essentially describing it as a costly decision taken by a person for tax reasons that otherwise make no economic sense. Now, the study didn't describe whether the tax was made to be explicit and a key motivator aside from an end price increase. But the author did see a possibility of people traveling to non-taxed areas, as it occurred in Philadelphia, where people consumed in surrounding areas to kind of avoid the tax. This result would show a small version of economic distortion acting, as people engage in the relatively costly activity of going to non-taxed areas to avoid the soda tax, because the tax exists. Which is, in my opinion, a little too much just to get a soda fix, but to each their own. This may be a stretch of the definition, so let's take a look at price elasticity, which basically posits that goods that are considered price elastic face a change in demand as their prices change. At the end of the day, that might be the easier explanation for the effect of this tax, as the study didn't find an increase in cross-border transactions and consumption in non-taxed areas. Of course, this is just one example of a specific good, and the trickiness of behavioral taxation and taxation in general is always because people and things have different qualities, standings, roles, and effects in society. One example can't necessarily work for, say, a tax on alcohol or cigarettes. In the end, this is a great example of how tax policy could be used to engineer behavior. In this case, as the author points out, public health policy being furthered by decreasing the effects of soda by limiting its sales due to price elasticity. So, those were two of the most interesting articles that popped on my tax newsfeed in the first couple of weeks of January. We saw that international politics can play a role in guiding tax policy, and how pricing aided by taxation and tax incentives can engineer decreases or increases in consumer behavior of products, ranging from electric vehicles to soda. So let me know what your thoughts are on these stories in the comments below. Thanks for watching, and be on the lookout for more of these videos, and of course the longer concept focused stories that I'll be working on.